Take a brief look at a position that I have in MES options. And what I did last night, is I started to create a straddle here with the intention of gamma scalping. For context, we can see that the market is up quite a bit. Well, it's up again today, and almost 133 points higher. This, I believe, should be close to all-time highs, if not all-time highs. But anyway, yesterday, let's go into yesterday. So here is where I entered into sell. I bought a straddle, and the strike line that I used was 76.30, and this left me a little bit long because the 76.30 call was at around 52 or 53 delta, and the corresponding put on the other side of the ladder was roughly 47.48. So note that left me a little bit long rather than delta neutral, and one of the reasons for that is if I'm long and the market rallies and vol drops, which interestingly, by the way, it's actually higher today. That's something else to keep in mind, but I'm not going to focus on that. If volatility drops and I'm delta neutral, then I'm paying the time decay, and it's costing me. I'm going to pay it anyway, but the options will lose value as vol drops, and that's obviously not such a good thing. So if I'm a little bit long as I initially create this structure, the straddle, and vol drops as the market is increasing in price, then the long position that I started with will defray the cost, possibly completely offset the cost of the options loss because of vol decay. Anyway, we see here that I paid $209 for the straddle, so $1,045, and the market rallied. When I did this, the market was probably up, I think, 100 less than current prices. So this was last night. Actually, why don't we just take a quick peek? 8:05 p.m. Let's see where this was. 30 minutes. So 8:05 p.m. It's 5:30 p.m. yesterday. Let's go to here. 8 here. So around 76.42. So let's just call it 80 lower, and from that point on, it just went straight up. All right, so I have the straddle on, and then prices increase. So the call that I bought suddenly becomes in the money by a bit more with each increase in price. And I get to the point where I want to start making adjustments. We can see here that right now this 76.30 call is a 68 delta, and the corresponding put is a 32 delta. So this leaves me long roughly 36 delta. However, earlier it was just 17. So the adjustment that I made was to sell a 79.25 call to capture some of that, capture some of the long delta, sell off a bit of it, bring me close to delta neutral again, not quite. Okay, that was done at 6:58 a.m. and the market has continued to rallied from that point on, still rallying. So I made another adjustment, and what I did was I rolled the 79.25 call down to 78.60, and that was done for however many delta it was, but that brought me back to basically delta neutral. I might actually be a touch short now, which I don't exactly mind, but let's see. So the difference in delta here is 36. 68 minus 32 is 36, and I have this 78.60 that I'm short, and that's worth a 37 delta. So I'm basically delta neutral, but I'm a touch short, which is fine. Now I will continue to make these adjustments as prices move. Hopefully they fluctuate. So ideally what I would like to see is a price decline and enough so that the puts actually go in the money, and then I can make an adjustment to the other side. And one of the things I can do is maybe I'll sell an out of the money put, because with prices going down, this put will start to, the 76.30 put will start to gain in value. Its delta will increase. It'll go more and more in the money, and that'll leave me net short. So what I want to do to get back to somewhere around delta neutral, one of the things I can do, I'm not sure if I'm going to do this yet because it depends on when and if this happens and which prices in particular we're talking about for the underlying. I could just sell put. That would leave me with a long put spread, long call spread, and then I just keep adjusting via the options. I can make adjustments by buying or selling the underlying itself. In this case, the underlying being micro futures. But for now, I'm just going to use options that'll be a little less capital intensive, most likely, than buying or selling the futures. And I have a bit more. I'll have some more options, so to speak, no pun intended, as far as which ones I want to use and how I want to use them. But for now, you can see that prices have moved up. This straddle, the call is now in the money, and the adjustment that I made to bring me back to close to delta neutral is selling out of the money calls. Well, sold one and then rolled it up because prices kept rallying. I will probably keep track of this for a while and see how it plays out. Again, I initiated this position last night, Sunday night. I was thinking about what was going on, and given that the presupposition is that I don't know or anyone knows where the market is going to go, I decided to go with a straddle, and you can make the case that vol is getting cheap in the index. You can possibly make the case that it is cheap. It depends on which metrics you use. But since vol is reasonably low and below the average, I decided that meant I wasn't going to be overpaying to put on the straddle. And this is one reasonable way to do it. And using the micros is a fairly reasonable way to do it, and you can still have all these options at your disposal to help you make any modifications that you feel are warranted. All right, that's going to be it for now. Thanks for tuning in.